Okay, picture this. You're sitting at your computer, just staring at your retirement portfolio. You've got literally decades of hard-earned savings on the line. Now imagine you ask an AI, like ChatGPT, what you should do with your money. It spits out a precise, incredibly confident answer. The question is, would you actually trust it? And maybe more importantly, if you did decide to listen, how exactly would that advice change your behavior? Welcome to This Explainer. I am honestly so excited to dive into this one today because we're looking at a truly groundbreaking behavioral study. The researchers here set out to answer a fascinating question. When real people are given high-stakes financial advice from a literal supercomputer, do we actually follow it? And the data they uncovered? Well, it tells a phenomenal story about human psychology, our egos, and ultimately, our financial futures. Here is our roadmap for today. We're going to hit 1. AI and your retirement, 2. The pension experiment, 3. The 37% shift, 4. Risk without reward, 5. The human ego, and finally, 6. The future of advice. Let's get right into it. Section 1. AI and your retirement. When it comes to algorithms and AI, most of us completely fall into this trap of thinking in absolute extremes. There's this myth out there that we either suffer from what's called algorithm aversion, meaning we just completely ignore the machine, or on the flip side, we show algorithm appreciation and blindly obey whatever the computer tells us to do. But the reality is far more nuanced. When real people with real money are given AI advice, they don't just say yes or no. Actually, it's more like they engage in this incredibly messy, ego-driven negotiation with the machine. Section 2. The pension experiment. So to see exactly how this negotiation plays out in the real world, let's look at the incredible laboratory setup these researchers put together. They recruited 400 adult employees in South Korea. Now, these are folks who are already enrolled in workplace-defined contribution pension plans, meaning they're actually quite used to making these exact kinds of decisions. Here's how it worked. Step 1. The participants allocate a hypothetical pension balance across 11 real-world investment products. Step 2. They're shown a recommendation generated by an AI. Step 3, they are allowed to revise their initial choices. And to make absolutely sure everyone took this seriously, their choices were run through a simulation and they were paid a real financial bonus based on the expected return and risk of the portfolio they built. The stakes here were very, very real. But here is the absolute genius part of this experiment. The participants didn't all get the same advice. The researchers secretly used 2 completely different AI models, fed them the exact same initial data on those 11 investment products, and got 2 completely different recommendations. GPT-4 Turbo acted as the aggressive advisor, suggesting a high-risk, high-return, highly concentrated portfolio. Meanwhile, GPT-4o acted as the conservative advisor, suggesting a much lower-risk, highly diversified portfolio. The participants, they were simply told an AI made the recommendation. This brilliant little setup allows us to see exactly how humans react to substantively different AI personalities. Section 3. The 37% shift. All right, moment of truth. What happened when these employees actually saw the AI's advice? Let's uncover the results. First off, a staggering 81% of participants were influenced enough by the AI to actually revise their initial portfolios. They didn't just ignore it, the AI definitely commanded their attention. But, and this is the really crucial point, 37%. The researchers found a 37% causal pass-through rate. What does that mean? It means that on average, participants didn't fully adopt the AI's advice, but they didn't stay where they were either. They shifted their portfolios to close about 37% of the gap between their original idea and the AI's recommendation. Basically, they met the AI roughly a third of the way. Now let's take a really close look at this chart, because understanding this visual is absolutely key to understanding the entire experiment. We're going to break it all down. First, look at the axes. The horizontal axis represents portfolio standard deviation. In plain English, that's your risk. The further right you go, the higher the risk. The vertical axis is expected annual real return. So higher up means more expected profit. See that solid black curve arching all the way across the top? That's the efficient frontier. It's basically the mathematically optimal balance of risk and reward you can possibly get from those 11 available products, which are shown as the hollow gray circles scattered around the middle of the chart. Now locate that little black square sitting right in the middle. That black square represents the average baseline choice of the human participants before they received any AI advice whatsoever. Next up, find the solid dots. The solid blue dot up near the efficient frontier, that is the aggressive recommendation from GPT-4 Turbo, high risk, high return. The solid red dot down on the lower left is the conservative recommendation from GPT-4 low risk, lower return. Now watch what happens when the humans are actually given the advice. The triangles represent their final choices. The blue triangles are the people who received the aggressive advice. Notice how they pull up and to the right, physically moving from the black square toward that solid blue dot. And the red triangles? Those are the people who got the conservative advice. They pull down and to the left, moving toward the solid red dot. But look really closely. The triangles stop well short of the solid dots. This right here is the 37% shift visualized. The humans are distinctly influenced by the gravitational pull of the specific AI they were assigned. It's dragging their portfolios in entirely different directions. But they absolutely refuse to go all the way. They selectively integrate the advice, while stubbornly anchoring right back to their original instincts. Section 4, Risk Without Reward. So this brings us to a really vital question. Did this 37% shift actually help them? Let's explore the financial impact. The AI's advice had massive, tangible impacts on the participants' money. Depending on which AI they were assigned, it fundamentally shifted their expected returns and their overall portfolio volatility. We saw pass-through rates of roughly 34 to 40% on how much they allocated to high-risk versus low-risk products. The AI even successfully influenced how many different products they held in their portfolio. So make no mistake, they were definitively taking on the risk profile of the machine. But here comes the twist, and it's a huge one. Even though they absorbed the AI's risk profile, whether it was aggressive or conservative, they failed to capture the objective mathematical rewards of the AI's efficiency. In finance, we measure risk-adjusted performance using something called a Sharpe ratio. The researchers found literally no detectable improvement in the participants' Sharpe ratios. None. They took on the AI's prescribed risks, but because they only went a third of the way, they fumbled the execution and totally missed out on the true mathematical benefit of the algorithm. Section 5. The human ego. So why on earth would they do this? Why follow the advice enough to change your risk, but not enough to actually reap the rewards? Let's look at the psychological culprits. This scatterplot brilliantly illustrates the human element in all of this. It breaks down the individual behavior of the 323 people who actively revise their portfolios. Let's dissect exactly what we're looking at here. The horizontal axis is the initial advice gap. This simply measures how far away a participant's original portfolio was from the AI's recommendation. The vertical axis is AI-directed movement. This measures how far the participant actually moved their portfolio toward the AI. See that dashed line shooting up at a perfect 45-degree angle? That represents full adherence. If a person completely surrendered to the AI and copied its portfolio exactly, their dot would land right on that dashed line. Now look at the solid black line cutting through the middle of the data. That line has a slope of 0.51, representing the mean weight on advice. On average, these revisers implemented about half of the suggested adjustment. But you really have to check out the incredible scatter of the dots. Every single circle is a human being making a financial choice. 95% of them, those are the blue dots, aimed in the right direction. They acknowledged the AI was pointing toward a better path. But look how far below the dashed line almost everyone is. They aimed right, but they consistently, stubbornly underadjust. And those red dots down at the bottom, those are the 4% of people who actually moved their portfolios away from the AI's advice. The humans just couldn't let go of their own prior judgments. All this data helps us build a profile of two distinct types of flawed investors identified in the study. First up, we have the overconfident investor. This person falsely believes their initial baseline portfolio actually dominates the supercomputer's recommendation. But here's the funny part. They still revise their portfolio anyway. However, because they are so confident or arrogant, they aim poorly, directing far less of their revision toward the actual AI target. Then we have the inefficient investor. Now, this person starts with a mathematically weak portfolio and actually seems to realize it. When they see the AI advice, they take massive steps, much larger revisions than the overconfident group. But tragically, they don't aim any better. They just kind of flail around, making big changes without actually getting significantly closer to the AI's optimal portfolio. And if you want to know just how prevalent this ego issue really is, notice the stark contrast in these numbers. After the experiment, participants were asked how their original portfolio compared to the AI's. A massive 27% of people mistakenly believed their initial choices had both higher returns and lower risk than the AI's recommendation. In reality, only 3% of people actually had a portfolio that objectively beat the machine. That means over a quarter of the participants suffered from severe financial overconfidence against a literal supercomputer.
Section 6. The Future of Advice.
Which brings us to our conclusion. What does all this mean for our relationship with artificial intelligence? The researchers sum it perfectly with this quote: General purpose AI may influence economic decisions not by replacing human judgment, but by providing a direction that individuals follow partially and selectively. AI isn't an autopilot that we're just going to blindly hand our lives over to. Instead, it's a powerful gravitational pull. It bends our behavior, it shifts our risk profiles, but it does so while constantly wrestling with our own stubborn, pre-existing human judgments. Which leaves us with this final, truly provocative thought. If AI is going to act as a gravitational pull rather than an autopilot, who is really steering your financial future? Are you taking the best of the machine, or are you just letting your ego water down optimal advice until you get all of the risk and absolutely none of the reward? Thank you so much for joining me for this explainer, and I highly encourage you to reflect on your own financial ego next time you ask an algorithm for help.